Great to be here for, again, a fourth year in the row, partnering with Council of the Americas for an annual panel. Actually, it's interesting, that the Americas Quarterly has this cover story on Latin American consumers. I've been seeing a lot of coverage in the press in general on this topic. In fact, domestic consumption has been a very important investment theme for private equity investors in Latin America over the last 4 or 5 years. It's certainly been a continuous trend. Sometimes there's this perception that the opportunities in Latin America are focused on export-driven businesses or commodities, agribusiness. In fact, domestic consumption has been a very important area of focus, again, for private equity investors for some time. But there have been quite a few deals, particularly even in the last year, in the consumer sector, in retail, education, et cetera, as we'll talk about on the panel. And I think it's an interesting opportunity to highlight the trends that we're seeing there. And we have a fantastic panel that has been on the forefront closing deals in those sectors over the last year or two to talk about that. Before I do introduce the panel and go on and open up the discussion, I just wanted to present a little bit of background on some of the trends we're seeing from the data that we collect at LAVCA. So very briefly, many of you will know the association. We are a nonprofit trade association representing today now over 150. Every year I come here and we get to add about another 20 or 30 names to that number. I think last year it was about 120 member firms. Those range from large global private equity firms active in Latin America to small funds, including venture funds on the ground and around the region. Some of you may be familiar with our website. For those who are not working in the industry but are interested in staying abreast of it, we have a newsletter which is distributed to over 4,000 subscribers globally. You can go to our website and subscribe for free. And these are some of the different research reports and information platforms that we host at LAVCA. So actually, one of the new research products that we produced in 2012 was a survey of global institutional investors in partnership with Collar Capital, a group that does quite a bit of global research. They're a secondaries firm, and they have actually a private equity school at London Business School. And one of the questions that we asked over 100 global institutional investors looking at Latin America was what sectors they considered to be most attractive in the region over the next few years. And I think, frankly, I was surprised to see this, particularly coming from global investors. You might expect, agribusiness or energy to be at the top, but consumer and retail was by far the most attractive sector. Actually, this is broken down by both Latin American pension funds and family office and international LPs, and both groups rated consumer and retail as the most attractive sector. So, there's a question of, is this coming from the reality in terms of the deals that they're seeing or what their fund managers are presenting to them or what they're reading in the press, self-fulfilling prophecy, but clearly that's where the interest is focused. And then as you drop down, you see educational services, third on the list, obviously very closely related to that consumer theme. This is a breakdown of some of the data that we collect at LAVCA. We've been collecting proprietary data on fundraising, exits, and investments for 5 years, since 2008, so we have a really detailed look at where the deals are being closed. And in the first half of this year, retail was a particularly strong theme. 28% of the dollars that were invested in the region were invested in retail-related deals. Another 12% invested in education. And in the other services, it's kind of small print. I can't read on this version, but there are a number of related sectors. One of the key drivers of this investment theme for private equity firms in the region has been the expansion of consumer credit, one of the topics that we're going to want to touch on today. So everything related to credit cards, financial services, but also auto leasing, credit services, mortgages, and housing. It's been an important driver, and some of those are embedded in some of these other sectors. You also see health and life sciences in there. So I'm just going to highlight some of the deals that we've seen over the course of the last year or two. Restaurant chains. For whatever reason, this has been, a really dynamic sector with some really interesting brands coming through. Advent International backing. IMC, International Meal Company, is actually a holding with Frango Asado in Brazil and a number of restaurants they have in the Caribbean and in Mexico. You can see a number of other restaurant chains listed throughout. Taco Holding Nexus has brought Krispy Kreme to Mexico, and they have 2 or 3 other restaurant holdings in that group. So it's been a really dynamic sector for investment. Another highlight in this area was the IPO of Arcos Dorados, the McDonald's franchise in Latin America in 2011, with 3 or 4 private equity firms behind it. That was it was about a $1.25 billion IPO in the U.S. on the New York Stock Exchange. So very successful deal. Retail, Muendi is I believe, a men's clothing, or Gavia, Colombo is a men's clothing wear. Our Happy we'll be hearing about today from our panel member from Carlyle. Teca Colorsetti is, again, a clothing retailer. But we've seen a number of deals that include everything from the Home Depot of Peru, clothing, electronics, consumer electronics is another topic we'll hear about today on the panel. Almost anything that can be sold to consumers, that distribution deal is a very important part of that. So retail, very significant. Education, Santillana is a publishing firm. Many of these other firms listed here are schools. We see schools going everywhere from, primary education through to technical schools, business schools, universities, generally private schools. Been a very dynamic sector, and a lot of, again, knock-on opportunities in areas like publishing, as we see with Santillana. Healthcare, an incredibly dynamic sector, everything from health insurance to hospitals to pharmaceutical, and actually pharmaceutical retailing, where we've seen a number of deals, another very dynamic sector. And then this is the other interesting piece of the puzzle that we've really seen develop over the course of the last year. And embedded in some of that data that I was presenting earlier, you'll see information technology has been a very important growth sector for private equity investment in Latin America over the last couple of years. But a lot of those IT or internet-related businesses are, in fact, education businesses, healthcare businesses, retailers that are leveraging the increased penetration of internet use in Latin America to market or sell products through the internet. So there's been quite a few deals in this sector. Peixe Urbano is the Brazilian platform that would be a Groupon model. Compara Online is a health insurer. Pet Love, you can sort of use your imagination online, animal, food, and that type of thing. And Despegar from Insight on the panel today is an online travel site. So there's been a lot of interesting overlap between the technology play and the consumer play in Latin America. So with that, I'm now going to open up the discussion to the panel. We, again, are really fortunate to have the representation that we have here today. We have Fernando Borges from the Carlyle Group, based in Brazil, incredibly busy over the last year doing deals. Scott Voss from HarbourVest Partners, a global fund of funds. Scott has been an LP in funds in Latin America for a long time, and they now have an office in Colombia and are actively continuing to build their presence in the region. Nnamdi Okike with Insight Venture Partners, a newer investor to Latin America, later stage venture capital investor that has backed quite a few interesting technology deals. And Enrique Bascur of Citigroup Venture Capital International, very long track record in the region, particularly active in the Andean region, a former board member of LAVCA. So in order to open up the discussion, what I'm going to do is just throw out an opening question to all of you to sort of frame the rest of our conversation, and ask each one of you to talk about, maybe we'll just go down the line, your consumer-related portfolio in Latin America. So what deals have you done? In Scott's case, he'll probably talk more about some of the fund managers he's backed and the deals that they've done. Talk about the deals that you've done over the course of the last year or two or three that have in some way taken advantage of the growth of domestic consumption in Latin America. So I'll hand it to you first, Fernando.
Okay. Thanks, Cate. Thanks, everybody, for being here, and thanks for the invitation. Our investment thesis in Brazil is very focused on consumer and retail. We have, since we started our operations in Brazil, we have completed 6 transactions. 5 of them were in the consumer retail space. So it's part of our investment thesis, but the way we define, we go more than consumer retail. We actually, what we are looking is to buy companies that sell to the middle class in Brazil. We believe it's a huge market, 60% of the Brazilian GDP, growing, having more purchasing power, more disposable income. Brazil will become the 5th largest consumer market in the world, probably by 2020. So we are trying to look for companies in this segment that are fast-growing, family-owned companies that we market leaders. And so our the 5 companies we have today in Brazil, 3 are in specialized retail. So we own a company called Scalina, which is the leading hosiery and lingerie company in Brazil. Has 2 brands. Trifil has 50% market share of hosiery in Brazil. And Scala is lingerie, has 120 stores. It's a company with $250 million in sales. And the targeting is mainly the woman consumer market, which is already the 3rd largest in the world. The other company we have that Cate mentioned is called, we bought 2 companies on the toy segment. They're pure toy retailers. One is called Rehappy, and the other one is called PB Kids. We bought those 2 companies early this year, and we merged the 2 of them. So we have 180 stores in Brazil, and $600 million in sales, 25% market share. It's and the reason is a very resilient market. And recently we acquired a company called Tok Stock, which is the leading furniture and decor retailer in Brazil. $450 million in sales, 36 stores. It's a mix of IKEA and Crate and Barrel model. Besides that, we have one company in the travel industry called CVCI, is the largest tour operator in Brazil, $2 billion in sales and 750 stores. The Brazil market is more similar to the European market, where people see travel, they buy package as a retail experience. So they go to a store in a shopping center and go and buy a travel package. CVC has today 65% market share of the organized tour market. And finally, we have acquired a company in healthcare. It's called Qualicorp, which is a healthcare administrator. So it's a sort of a broker. It's a company with $500 million in sales and sell insurance plans for almost 4 million people in Brazil. So that's our portfolio.
Okay. Just one quick follow-up question. You recently acquired PB Kids following the Already Happy. Do you see more opportunities in that particular niche? Are you looking to do sort of a roll-up strategy where you acquire more companies in the toy segment?
Actually not. We don't. Actually, we don't do a roll-up strategy usually. I mean, we try to go to the number 1, number 2 companies. So basically, in the case of this transaction, the idea was to buy the 2 of them. Our major competitors now are basically the big retailers like Walmart, Carrefour, Lojas Americanas. So the idea now is grow more in babies, in online, but not to roll up and buy others.
Okay, great. Scott?
Thanks, Cate. So just some background. HarbourVest has been investing in Latin America since the early 1990s. As Cate mentioned, we are generally thought of as a fund of funds, but we actually invest in funds. We do direct co-investments alongside managers. We also buy secondary positions in funds. So since the early 1990s, we've invested about $500 million in Latin America through primary investments, secondary investments, and direct co-investments. If I start on the direct investment side, we've done 3 deals in Latin America. One was a transaction processing company, which definitely benefits from the growth of credit card adoption in Latin America. We also have invested in a supermarket company in Latin America, and I think as you look through many of the portfolios of many of the managers that Cate profiled in her opening, you will see that there are a number of retail, supermarket / department store concepts, and it's a very common theme across many portfolios. And then finally, we've invested in a Pepsi bottling company, and if you think about the middle class consumer drinking beverages like soft drinks, that's obviously a very big growth category. So that's on the direct investment side. If you look into our private equity portfolio, I'd say our managers are investing into two big broad themes. The first is this domestic consumption theme, the emerging middle class, and trying to gain more of their share of wallet, they call it. The second theme is a global consumption theme that really is being driven by growth that's happening in developing Asia, primarily China and India. That also is an emerging middle class story that's creating demand for resources in Latin America. So there's a very good complement in those two big themes across our Latin America portfolio. But if I just bring you back to the domestic consumption idea in Latin America and maybe give some examples of the types of companies that we've benefited from in our portfolio. First, let me talk about a couple of deals that have actually been fully exited that have generated good returns for us. One of our managers in the 1990s invested in a company called Cinemark Brazil. It was actually a joint venture with Cinemark USA. And even during the very challenging times in Latin America, that company was able to grow aggressively through a difficult macroeconomic environment. It was ultimately sold to the joint venture partner or the parent, Cinemark, and was an attractive exit in the portfolio. I think it's an important example to know who your buyer is when you invest in the company. But benefiting from the fact that people are spending their incremental dollars or disposable income on entertainment and looking for entertainment when they go out at night. Another company which is indirectly tied to the consumer is called FEMISA. It's a concessions company. Advent International basically owned the concessions at the international airport in Mexico. And through that, they built a number of retail concepts around those concessions, and that was, if you think about long-term contracts and predictable cash flows, it was a very attractive investment, and they were actually able to do multiple recapitalizations because of the predictable cash flows and generate a very good return for investors. But again, the underlying driver there was being able to populate these locations with retail concepts that consumers were going to purchase from. So those are two exits in the portfolio. Maybe if I talk about two newer deals in our funds that have not been fully realized. One Cate referenced, it's called Moendi. It's an optical retail concept in Mexico. If you merge the consumer and the healthcare trends that are playing out in Latin America, and the fact that as the middle class consumer becomes more fashion conscious, they're going to go spend money on brand names around optical eyewear. And this company is basically looking to grow its retail footprint, both organically and through acquisition in Mexico, to benefit from the opportunity to sell to a consumer who's looking both for to improve their eyesight, but also improve their fashion. The final deal is called Brinox. It's a Brazilian company, a Brazilian kitchenware company. So if you think of KitchenAid in the United States, this is the domestically manufactured product that's targeting the upper middle class consumer in Brazil. So they're actually pricing their product and positioning their product against Chinese imports. And that company has shown very good growth during the 2 years that it's been in our portfolio. So I think that's a pretty good cross-section of the types of opportunities that we see in Latin America. What's fascinating for me is that if you put a Peruvian fund portfolio next to a Mexican fund portfolio, next to a Brazilian fund portfolio, next to an African fund portfolio. And you take away the names of the companies and you just look at the descriptions of those companies, you will see very similar portfolios that are all investing into some of these common trends and common themes. You'll see K through 12 schools, you'll see retail pharmaceutical company, you'll see a theater chain, you'll see a health club company. These are trends that are playing out throughout Latin America and actually throughout the developing world.
You know, Scott, I can't resist doing a quick follow-up on that. Scott has actually been based in Hong Kong for the last 2 years and is actually, I should mention, also a LAVCA board member, having joined now in September. Is there anything that you see that is specifically different in Latin America in the consumer space that you don't see in those other, in Africa and Asia? Is there anything that is just fundamentally different, or you would be more inclined to highlight the similarities?
What's different? Well, everybody's different. Well, let's see. You know, that's a hard one for me to
I'll let you think about it since we need to go on to Enrique in any case. But you have to come up with an answer before the...
Yeah, you know, I guess what I'd say about Latin America, if you compare some of the other developing world economies outside of Asia, so take China out of the equation, you know, maybe include India, I think it is generally more developed than Africa. So if we're talking about Brazil and Mexico and Colombia and Peru and Chile, you know, these are fairly advanced economies. And it's probably not fair to lump them all into the same category, especially if you're talking about sub-Saharan Africa, which is very different. Yeah.
Okay, great. Actually, this is something that Enrique could probably touch on as well broadly, because CVCI is a very global player with a portfolio of private equity investments in emerging markets around the world. But Enrique, maybe you could talk a little bit about some of the investments that you have in Latin America today.
Sure. I think that what Scott mentioned about, you know, having a portfolio driven partly by the consumer, world consumer, and partly by the Latin American consumer is a theme that you'll find in most funds. I'll leave aside the ones that are driven by the world consumer, like, you know, fish meal in Peru and that kind of thing. In terms of businesses driven by the consumer in Latin America, I think that I would put what we have in three groups. One is what relates to the increased spending in entertainment, travel, where we've invested in lodging and entertainment, both in Mexico and Chile. I'll talk a little bit about those companies. Then the increased ability of the consumer to acquire homes, the availability of financing and so forth, where we've gone into the home building business. And then the increased technological consumption, the consumption of technological items, computers, etc., where we've invested in the distribution of IT products. In terms of lodging and entertainment, we have a company in Chile which is called appropriately Dreams. It's a company that has developed 4 hotel and casino operations, 4 new hotel and casino operations, and acquired 2 other operations. It has 6 altogether along all of Chile. These are local operations that are very targeted to be the entertainment center for a small city, where you don't have the infrastructure, where you don't have restaurants, you don't have much of that. You build a hotel, build a small casino, restaurants, entertainment, and provide a venue for the city to have shows. You build a small convention center that allows the city or the population of that city to have a venue to have theater come in and so forth that was not available before. It essentially changes the infrastructure for entertainment in all these places. And it's a business that is dramatically successful. We've built a company from acquiring the two initial properties that had about $15 million in EBITDA to a company that today is going to be around $75 million in EBITDA and continues to grow, and it's generating cash tremendously. We always had also a small operation in Peru that the company is looking to expand that as the market in Chile is already covered, and you will probably see a consolidation play in that sector going forward. Mexico, we've developed a hotel chain. It's not a branded hotel chain. It's a franchise hotels. We operate under Holiday Inn Express and Hampton Inn. We've built about 2,300 rooms across Mexico, and that plays to the increased ability of the domestic population to travel, as well as people coming in from outside of Mexico. In terms of the real estate, the home builder, that's where we've seen the biggest change. I think we've held this company. It's a company in Chile called Moller y Pérez Cotapos, which was a small real estate developer and construction company that we acquired about 5 years ago, and that we have enjoyed the enormous growth of the real estate market in Chile, the housing market, where you have mortgage financing available at 20 years at rates that are fairly low relative to what you see in the rest of Latin America. And you've had an economy that's been growing steadily, expanding and reinforcing tremendously the middle class. We've been able to build up this company several-fold in terms of the volume of sales of units to the consumers in Chile. We've also seen the opportunity to expand the business to, this was a company that was really targeting the middle class and upper middle class. We've gone to a lower segment and developed a whole business in lower cost housing, which is the largest segment in terms of volume, in terms of number of units. What we've seen, and we've seen some interesting trends there, is that one, the consumer is more and more demanding. The regulation that protects the consumer is more demanding. You have today, you can't just wing it. I mean, it used to be that people went out there and built an apartment building and sold them and forgot about it. Today, you have to, have a post-sale service unit that is prepared to deal with the demands of the consumer, to the standards that are required by the government, et cetera, et cetera. And it's not easy when you are building high-rises in a country that has big earthquakes every once in a while, and people expect it not to crack. So, the demands that the consumer are putting on these investments we make around Latin America is a trend that is changing, and changing very fast. I mean, I think that people who've invested in education can also attest to that. And finally, the other company, Incomex, which is a company that distributes IT products, is a company that distributes across 12 countries in Latin America, and is the one that is the most subject to the whims of the consumer, which is changing fast in terms of preferences, which can change what you may have been seeing for a while in terms of people replacing their PCs or replacing their laptops. Suddenly the switch into mobile phones or smartphones or tablets is quite fast, and sometimes faster than what you see in developed markets. And it's easy to be caught by surprise by the shifts that you see in the Latin American consumer, who's responding more rapidly because it's not so invested in older technologies and is much quicker to adopt the newer technologies.
That's very interesting, Enrique. I hadn't realized that technology company was actually is it selling to consumers directly, or
No, it only sells, only distributes on the mobile phone part, distributes directly, has some direct distribution to consumers, but it sells to department stores, sells to a lot of retail, distributes into the retail chains in a number of countries.
Okay, great. Well, perfect segue to toss it over to Nnamdi, who's going to talk about the portfolio of insight and one of those is in fact a consumer electronics retailer.
Yeah, I think it's a great segue, Enrique. You know, just to give you some background on Insight, we're a growth stage venture capital fund, so we invest only in software and internet companies. We've been investing in Brazil probably a relatively short time compared to these guys, about 3.5 years. And what got us into Brazil was a couple of things. First of all, the growth of the economy, as everybody knows. I think particularly given the growth of the middle class, there's increased purchasing power. I think one stat that I saw that was quite interesting is that 10 years ago, about 37% of the population was in the kind of Class C, middle class. Today, it's 55% of the population. So you're seeing a fairly rapid increase in earning potential. And I think with that, you're seeing increased purchasing in some of the areas that we focus on. I think the first area is e-commerce. We've done 4 investments in e-commerce. We've probably put to work upwards of $100 million in those companies. And what we like about the e-commerce market is, first of all, today, the e-commerce penetration is a fairly small percentage of retail penetration, but it's growing very quickly. Today, about 3% of the market, of the retail market, is transacted online. If I compare that to the U.S., it's about 10%. So there's a lot of growth opportunity. Just to highlight a couple investments that we've done in that sector, and we've primarily focused on Brazil, but we're increasingly looking at other countries. The first is a business called Kaboom, which is dovetailing with what you were talking about. They sell IT products and consumer electronics online. It's really primarily focused on consumers. They sell TVs, they sell computers, notebooks, laptops, founded by 2 young entrepreneurs in their 20s. And they saw this opportunity. They had a physical retail store, and they took it online, and they just grew by leaps and bounds. Last year they grew over 100%. And I think what they do well is they've got great customer service. They've got a wide product selection. They ship throughout the entire country. And there's just a large demand for these types of products. I think historically there's been a scarcity, and now there's increasing demand. So they're doing quite well. I think the second area I would talk about is healthcare. We've made 2 investments in healthcare IT. And as we were looking at the market, a couple things jumped out at us. I think the first thing was for every 1% increase in income, you have a 1.3% increase in healthcare spending by consumers. So, as people become increase in income, they oftentimes will spend on healthcare. And we saw a big opportunity to invest in companies that were providing solutions to hospitals primarily. So we made 2 investments. The first is in a business called BioNexo, which is an online procurement platform for hospitals. So it enables hospitals to source medicine, to source equipment, to source basically the infrastructure for their hospital. And what's interesting about that business, it basically creates a more transparent market. So whereby a hospital before might have contracted with a couple suppliers, now they can see hundreds of suppliers on their platform, find the best price, make sure that the contract is bid in the right way, and kind of simplify the process. So we think there's a great opportunity for them as hospitals have more money to spend. In healthcare, another stat I thought was interesting is that healthcare spending today in Brazil per capita is about $900. In the U.S., it's more than $7,000. So, again, the macroeconomic factors in importantly. I think the last area that we've invested into is education. We've made 2 investments in education. The first is a business called Whitney University, which runs a set of universities kind of post-college across Brazil. So they're in, I should say across Latin America. So they're primarily in Brazil, but they also have schools in Colombia, in Peru, in Mexico. They basically run these schools, and they also do online courses. So it's a kind of a dual model. And it's a company that we think is doing well. It's also doing good because they're very high enrollments. They're helping people to kind of gain skills that they can use vocationally and otherwise. So we think that's a business that is doing a good job and also running a good business. So those are some of the things that we've focused on, and I think just to reinforce some of the things that these guys talked about, I think as we see increasing purchasing power through the middle class, I think we're going to see a lot of continued growth opportunities in these verticals and in other ones as well.
So Nnamdi, that last topic you raised on education and a business that is effectively in Brazil but pan-regional as well, again, interesting point to raise. Most of the portfolio companies we've talked about here so far, to my knowledge, are focused on a single market. They're not necessarily cases of where a brand has been extended across multiple markets. So maybe we'll kind of work our way back, but if you can just talk about how that example in particular, how you've moved from Brazil either into other markets, or in what way is that business able to, is it a single brand? Is it different brands in each market?
They've got different school brands in each market. I think the operating principles are similar. It's manage the schools. It's the same types of students. It's kind of college and kind of postgraduate. It's provide a kind of a broader set of courses than you can typically get in a public institution. I think for them, it was the idea that they've done this in the U.S. and they've done it successfully. They saw a couple of markets, and I think they saw similar kind of demographics in terms of student and kind of increasing willingness to kind of be able to spend money to kind of increase education. So I think they took a principle that was working and they applied it across different markets. I would say, in terms of kind of companies that are going across countries in Latin America, there are different models. I would contrast them with, say, a Decolar, which is really the brand. They're in Latin America, they're in Colombia, they're in Peru, and they're a well-regarded brand, and they're an online travel business. And I think one thing that makes sense in terms of them is people are flying between countries, so it's logical to advertise in Brazil for somebody who wants to travel to Argentina or travel to Peru. So it really depends upon the business model, I would say. I think for us, we oftentimes just look at the market potential and market size, and I think what we've seen increasingly is we began in Brazil because it was the biggest market, but we're seeing a lot of growth opportunities in other areas as well.
Is Kaboom selling outside Brazil?
Kaboom is only Brazil today. Okay. Kaboom is only Brazil. They may look to expand. I think for them it's a matter of, their site is only in Portuguese, so they'd have to localize it for Spanish-speaking markets. They'd have to think about finding suppliers in those countries. They'd have to think about kind of marketing those countries. But I think that's also a business where you can apply the core operating principles into new markets.
So Fernando, looking at some of the investments that you've been talking about, are these exclusive, they're businesses that you've acquired in Brazil? Is there an opportunity to build those brands or build those companies into pan-regional plays, or will they stay focused in Brazil?
Well, that's a big dilemma that we have, because the model that we have, we usually buy control, but we keep the founder with a 30-40% of the company. So when we approach the founder and try to differentiate ourselves from our competitors, one of our selling points is we are a global firm, we have a global platform, so we're going to help you to expand regionally or internationally. And most of them, they buy this. Okay, interesting, I wanted my company to be global, to expand. And then when we buy the company, we say, well, we don't have time to go outside because, for instance...
This is being recorded, you might want to think about it.
No, but for instance, CVC, which is our travel business, the founder used to say, CVC very strong in Brazil. We send people to Argentina. It's a very well-known brand in Argentina, but it's not well-known in other... Decolar is much more strong in the other Latin America. And our founder used to say, I want to get this market, 400 million people, that goes from Ushuaia to San Diego. 400 million people that speak the same language and pray for the same God. So this is a huge opportunity. And we generally believe on that. The problem is, when we bought CVC, this year we're going to transport 3.6 million people. Almost 1 million people never traveled before. So still the market in Brazil is still very huge. Those are people that they are just becoming our first-time customer. And so you try to go outside, it'll be interesting to go to Colombia and Peru and sell package for them. But the problem is the company is growing a lot only in the domestic market of Brazil. And the same, with the toy business, there's a huge opportunity outside Brazil. But still this year, which is a tough year, Brazil is not growing. This company is growing 23%. 19% same-store sales is still, there's still a huge market. The company is expanding to the northeast of Brazil. The northeast of Brazil grows at a Chinese rate. And there, people are not buying cars. There, people are buying food. They're buying more beverage. They're buying basic things. But toys, they're also buying. And there, I don't compete with Walmart and Carrefour because it's much more difficult for them to be there. So that's our dilemma. We buy those companies. They have very strong brands in Brazil. They are very well-known brands, present. That they could have the potential to go outside, and probably most of the founders associated with us to help them there. But at the end, we don't want to leave the market for others here. We want to capture. So it continues as in our business plan, but it gets always delayed.
It's always the implementation that's the hard part. No, it's the truth. It's so easy to talk about Latin America as one market and one market of consumers, but sometimes the reality behind that is more complicated. We were talking about the fact that you've opened an office now in Peru. If there was a target company in Peru, somehow there was a toy company, a toy business there, distributor that was available, I assume there would be a synergy for...
Exactly. So we open our office there, so now we can expand companies there and hopefully bring them also to Brazil, right, where there's a huge market for this kind. Even though some businesses are very local, what are some of the businesses that you would describe as more local?
What kinds of businesses do you think might be more successful as pan-regionally?
Some of the examples you gave there. Restaurant chain. That's something difficult for you to replicate. First, because people eat different things in different countries, right? So, some places they can eat chicken a lot, and probably not in Brazil, where they eat a lot of meat, or in Argentina. So, restaurant chain is very difficult to replicate. Travel is easier because people travel, and 30% of the Argentinians they travel to Brazil, so they know our brand without. Even if we don't have one single store in Argentina, they know our brand because they come here. Mm-hmm. So, but for instance, restaurant chain is
you should see what they serve at the McDonald's in China, actually. Some companies have been very good at Scott, you look at you take kind of a big picture view of the region as a global fund of funds. How do you think about, the opportunities in different markets? And when you choose fund managers or look at a direct investment opportunity, are you thinking about this is a great opportunity in Peru or in Chile or in Brazil? Or are you thinking about, I want to see a company that's going to be able to span all of Latin America?
Yeah, I think it's a little bit of both. And maybe if we just start at the fund level, we invest in firms that are characterized as pan-regional. They have a presence maybe in Brazil and Mexico, perhaps Colombia and Peru, and then we also invest in country-focused funds. And I'd say there's benefits to both. If you're a pan-regional fund, you've got flexible capital. So if the Brazilian market, for example, gets pricey or the Mexican market gets pricey, you can reallocate your capital and your resources to perhaps Colombia or Peru. However, it's hard to build a firm that has a team that has local networks in each of these markets so they can actually access really good deal flow. So to be focused on a particular country, if you're a pan-regional fund, you have to build a dedicated team in each of the countries that you're executing on. And then when it comes to the company level, I think it varies. Maybe I'll kind of follow on where Fernando was talking about with Brazil. Brazil's a big market. It's 40% of the GDP of Latin America. It's a big opportunity, and just to execute on the Brazilian opportunity is a big opportunity. So companies should be focused. But as you move to some of the smaller markets, it's probably easier to really fully execute or tap the opportunity. And if you have a really good concept, you may want to look beyond that market. And we've seen some big retailers in Chile, for example, become pan-regional. Peru is a very dynamic economy with some very good companies, but it's a smaller economy, so perhaps those concepts can be taken outside of Peru. Even on this restaurant concept idea, there's a restaurant that's fairly well known in Colombia, in Bogota, called Andres, which if you haven't heard of it, most people from Bogota will tell you the first thing that comes out of your mouth is, if you say I'm going to Bogota, they'll say you have to go to Andres, and they'll tell you, every night is different, and every night's the most amazing night you've ever had, and you sit there and say, I got to go to that place.
It's kind of a club in addition to a restaurant. We might want to throw that in there.
But they serve food. It's all right. It's all right. But the rest of the atmosphere is great. And they're not taking a food concept and bringing it someplace else. It's really taking an experience and bringing it someplace else. So, I think it's a mix of both. There are some concepts that will just be country focused, and some that you can go pan-regional with. The reality is, if you look at a lot of the companies in Latin America, they're borrowing ideas from the rest of the world. You will find the Home Depot of Peru and the Home Depot of Brazil and the Home Depot of Mexico. They're all borrowing that idea, so there probably is an opportunity to create pan-regional plays. It just hasn't played out that way, not yet. And maybe as the industry matures, you'll start to see some consolidation within the region instead of seeing a global strategic come in and consolidate.
Enrique, I'm not sure if I understood you correctly when you were talking about the casino business in Chile, that is something that you're expanding now into Peru. You're looking at opportunities.
We always had, the company always had an operation in Peru. It's that operation that's going to be expanding.
And is it, how are consumers different in those markets? Is it under the Dream brand? Is it a bit different kind of an experience than what you were describing, the experiences for Chile, for the Peruvian market?
Well, in Peru, we were not operating directly gaming floors or casinos, so I couldn't tell you at this point, what the difference is between the Peruvian and the Chilean consumer are in this regard. I can tell you that the markets are very different because of the regulatory environment. Peru is a much more open and competitive environment for gaming. You have many gaming venues in all cities all over Peru. So there is a competition, direct competition, while Chile has a regulated monopoly with revenue sharing with the government, which is much more, it's a very different model. I think both models work very well, but we are more familiar with the Chilean model, and we're familiarizing ourselves with the Peruvian model.
And in the casinos in Chile, are they targeting, is this middle class? Is this upper middle class? Is this an experience for, everyone who's living in the town that you described?
It's really middle class. It's really middle class, very broad, very broad. It's a very broad experience. In fact, one of the mistakes that we made in the initial stages when we opened some of the first operations was to target too high. Like we would have a luxury car that would be part of in front of the casino, that would be raffled at some point, as part of you could win it in the slot machines, and people were intimidated by that. They were intimidated by things looking too luxurious and would not go in. Change that for a Toyota, and people started loving it. It's really the middle class that goes there, and it's the entertainment. You bring in local entertainment. You gave opportunities to local performers, rather than at first we brought in I don't know, Casey and the Sunshine Band and things like that. It was expensive and disastrous. Today you give opportunities to well, they happen to be there. They happen to be at a festival in Chile at the time. We really have had to tailor the whole experience to that level. The restaurants we had initially had a very sophisticated menu. It was, designed by a chef, and they had all sorts of funny things. People just wanted meat and potatoes, essentially, and we simplified that to pasta, meat and potatoes, and very well prepared, very good service, very nice venue, but what people really want there. So it's really targeted to that middle class, and it's amazing if you go to these towns and you see how people go in. I mean, it is the whole town.
How has that translated in the hotel business in Mexico, also targeting a very specific segment? Did that sort of work the first time, or what was the strategy? What is the product like, the experience like for that very middle market hotel business traveler in Mexico? I mean, they're probably quite different from.
Very different. I mean, it's a very different, and it also happens in the hotel business in Chile. That there are two different markets. In Mexico, it's been a mix of the foreign business traveler that is from a mid or lower level in a corporation that has an operation in Mexico and has to travel frequently there. They use those hotels, and then the Mexican consumer that travels to through between cities in Mexico. It is, the middle class. It's the middle class that's migrating from the mom and pop hotels that were very poor infrastructure. Standards are very low. You find bad beds, bad rooms, no air conditioning, many things, plumbing problems, etc. And at the same price. So that has caused the consumer to migrate very quickly into these better quality standardized hotels. In Chile, in fact, the hotels that we run, we have 5 of them, are more luxurious. They tend to be the best hotel in every city where we are, and they target a much more of a business traveler or a higher-end traveler, a tourist traveler, but they are totally separate as a client group from the casino that's next door. The casino and the convention center, where you have these large rooms for you can have parties, you can your weddings, the local weddings, any event, organizations from the town, they have all their events. That is 100% local. Well, the hotel, which is right there, is really where it's a crowd that doesn't even go into the casino.
Nnamdi, can you talk a little bit about the consumers that are buying over the internet? I imagine you may have a slightly different demographic than some of the other more traditional bricks and mortar businesses. Is it typically young people? And how do you create brand awareness or market those businesses? Is it strictly, do you use social media strategies, or what other types of strategies are you using?
Just before getting into that, I wanted to say that I like this panel because no matter where I go in Latin America, I'm going to know where to eat and where to stay. So it's great. So I think in terms of the internet population today, I think for the businesses we focus on most, it's primarily, I would say, kind of, people that kind of from the 20 to 40 age group. If I think about, Kaboom, for example, most of their consumers are individuals that are maybe college age, maybe they're getting their first job after college, they've got disposable income. Not to say that all e-commerce companies are targeting that demographic, but I think a lot of them are. So I think the way that we reach them is either through Google advertising, it could be Facebook advertising. Some of our companies do offline advertising. So It could be sponsoring a basketball team. Kaboom does that. Or it could be, advertising via TV. We always like, marketing where you can track it, and it's you can kind of see your return on investment. But it's not to say that all companies are solely focusing on that demographic. If I think about Decolar, they've got a fairly broad age demographic and kind of population demographic. I think that one of the stats you mentioned in terms of the number of people that are flying for the first time is pretty incredible in Brazil. So it's not solely young people. It's not solely affluent people. I think it really kind of crosses many lines, and I think that will continue to be the case. I think if you look at broadband penetration in Latin America, it's still relatively low compared to other countries, and but the growth rate is very high. So I think, as you've seen in the U.S. and in Europe, I think you're going to see e-commerce kind of targeting a broader base of the population.
And do some of the models that have worked in the U.S., say again, like a daily discount Groupon type model, do they translate well, or we don't know yet? I mean,
they translate to an extent, but I think I'm always in favor of entrepreneurs who have a strong knowledge of the local market. I would compare. We looked into, for example, the baby products market. We didn't end up making an investment in that market, but we looked at two companies. One was founded by local Brazilians who'd grown up there, who kind of knew the market. Another one was founded by two Americans, and both were good companies. But I think they were addressing different challenges, and I think what we liked about the Brazilian company is the fact that they really understood the geography of Brazil. They understood that shipping to the north or shipping to some of their customers were near the Amazon. That's challenging. You can't offer free shipping if you really want to make a profit off that sale, and you have to think about returns, and you have to think about tax regulation. So I often favor entrepreneurs who understand the market, who aren't just trying to transplant things that have worked in the U.S. to whatever the country is going to be, because usually there's cultural nuances. I think, as people have talked about, understanding your consumer, understanding their buying habits, that's important. I think regardless of what kind of company you're investing in.
actually, you raised one of the first topics that we had to discuss, very related area, which is logistics. So actually going back to our data, logistics was, I think, the second sector for investment in the first half of this year. And as we see both internet businesses shipping things around, but traditional businesses as well, this is an really important gap. Fernando, I mean, do your consumers buy in-store, or what kind of challenges do you have in terms of roadways and other, physical logistics to be able to get products around?
How long do you have?
You're still making money, I assume. I don't know. Are you doing infrastructure investments as well?
Because the logistics and infrastructure problems of Brazil are huge. I mean, that's a very important bottleneck that all our companies have. Because I imagine e-commerce. We look at some of those baby companies as well, and they can only ship things to São Paulo, because otherwise, anywhere else it's totally unfeasible to send something to the Northeast. We have traditional brick and mortars, our companies, so they have their own logistics, but the problem is the cost. So you companies in Brazil cannot be competitive because of the logistic costs. So companies like, for instance, our travel business, CVCI, during the high season, sometimes we charter 150 flights per week. For Brazil, that's a lot. And we could be shipping more people, but there's no planes. There's no, the airlines are struggling, and they have to reduce supply. The airports are awful, so it's so that's a scenario. The good news is, people criticize a lot infrastructure, but if we look at the amount of money being invested in infrastructure, is not enough, but it has increased substantially. From 2005 to 2009, Brazil invested in infrastructure 35 to 60 billion reais. From 2010 to 2014, we are investing 100 to 160 billion. So it's like 3 to 4 times more than we invest in the 5 year. It's still, investments only account for 19% of our GDP. By 2014, people believe that we'll go to 23, 24. There are the big events in Brazil in terms of, World Cup, Olympics. So we're going to see some better airports, better road there, and all the investment from Petrobras and everything. So they're increasing substantially the investment, but it still is not enough, and this is still bottleneck, and it's not going to be solved in 2-3 years. That's going to take a generation to solve. So companies will need to learn how to be competitive with the incorporating this cost, because it's not a short-term solution.
So it's
the trend is positive, but it takes time.
A generation, that's not,
Yeah.
that's significant. Scott, if you again, being able to have the global view, how would you compare Latin America to, other emerging markets that you're familiar with in terms of infrastructure and, what the cost of the lack of that infrastructure is for investors? I mean, it has a real direct cost.
Yeah, it's interesting when you look at the developing world. We do have a lot of infrastructure in our private equity portfolios versus if you look at the U.S. or Europe, there tends not to be any infrastructure in the private equity portfolios. You have dedicated infrastructure funds. And the reason for that is they have different return targets. But you can actually generate a private equity return through infrastructure investments in Latin America, in Africa, and other, China and India. And in the types of investments you might see, airports, radio towers, toll roads, ports, waterways. And some of these, if it's an energy project, for example, it might be a greenfield project. You have to build it from scratch. You can generate a very attractive, 20+% IRR with that investment. And there's an arbitrage play because there are investors, institutional investors around the world that want to buy those assets when they're mature, and those investors have a low cost of capital. So you're underwriting a return of 25%, but some large sovereign wealth fund is coming in with a cost of capital that's 10 or 12%, and you can make a pretty good return if you can actually build something that doesn't exist. So a lot of the infrastructure investment in the U.S. and in Europe is actually upgrading existing infrastructure. It's not building something brand new. And as Fernando said, there's a tremendous need for new infrastructure in not only Brazil but all around the world, all around the developing world.
Does HarbourVest invest in infrastructure funds in Latin America? I don't think you do.
We don't, but we do have, through our private equity investments, we do have material positions in what would be categorized as infrastructure deals. But the investors are targeting a private equity-like return.
Okay. Yeah. So infrastructure or lack of logistics distribution is a challenge. I just want to shift over to the consumer credit topic and see how each one of you is selling to the consumers that are buying your products. Is everyone buying with credit cards? What types of credit products are out there? And are you concerned at all that there's been some concern in Brazil and actually a situation in Chile that was very specific about how consumers that are not familiar with credit products are buying all of these things on credit. Fernando, maybe we can start with you and go down. Brazil in general, they only buy if there is credit, right? And they like to buy installments. Maybe that's one difference from Hong Kong. Right?
That's a difference. Yeah.
So, especially for high ticket items, for instance, in our case, credit is very important for our travel business. The average cost of a package is $700 per person. You don't travel alone; you travel with someone and kids. So it's the price. It's the price of a TV in Brazil. $2,500 per. So people need to finance that. Usually 10, 12 installments. Since we don't want to take the credit risk, is done through credit card. But in travel, at least the default rate is very low because today you are buying a package for the carnival, right? I mean, your December and January is gone. So you buy a product that you only use in February, but you start paying now. Usually when people default, they default immediately, or 1 month later. So after paying 3-4 installments, usually you don't default. And especially on travel, you still can cancel the travel. I mean, if the person doesn't pay, they don't get on the plane. So for travel, it's less problematic. In our furniture is also a high ticket item. So also we're financing 8 to 10 installments, credit card because you don't want to take the risk. But also the default rates are very low because it's not a very expensive item. Toys and female underwear. I mean, you don't need to buying 10 installments. So usually there are much more. Very low ticket items. So it's credit is much less important. And but I mean it's part of the Brazilian consumer habit. You need credit, and I mean the good news is interest rates in Brazil are historically low. Still not low compared to what you have here, but it's historically low. And so, I mean, the government is paying attention a lot on that. And so, I mean, we should see default rates declining again, and the low interest rates should boost consumption even more.
Do you have branded cards? Like, is there an RI Happy credit card or any, particular?
We have just launched one with CVC. That is a branded card. So people can. Because one of the challenges we have a lot of sales that are canceled. I mean, they are not approved by the credit card because you buy $3,000 on your credit card and then you use all your limit, even if you're paying 10 installments. And you need your credit card to spend when you are on vacation, right? So we are launch our branded card because then you can use this card and don't take the credit from the other card. So we're doing something with CVC in this line, and I mean the idea is to do with the other companies as they get more. When they start getting audited, they have controls process. Then we can think about the
cross-branding cards and all this. Enrique, how has the expansion of consumer credit? I mean, I know among others you were talking about the housing, so mortgage markets.
Yeah, certainly. A big driver of the housing market is the expansion of mortgage financing, which is a form of consumer credit. We don't sell, we don't provide credit. We do have, we just take deposits, or at the time we sign a promise to buy a unit, and then the financing is provided by the financial system, which is quite agile in doing that. I mean, it's a very fluid process, and that's been in place in Chile for a very long time. So it's a very well developed market for mortgages, and the effect that we've seen is just that the drop in interest rates has made this much more affordable for the consumers, and the extension competition has taken these mortgages to be extended in tenors, and making again the installments smaller and allowing people to buy better housing, and the impact of that has been tremendous. On the other businesses in gaming, we don't provide credit. It's not permitted by law in all the new properties. In the old properties we have, we could do it, but as a policy we don't. We don't think it's a good idea. And all the credit that we provide is in the hotel business, but it's mostly corporate. So it's,
I mean, do you, just asking you broadly, is with your track record in the region, how confident are you that Latin American consumers in the different markets where you're active understand the risks, understand interest rates? I mean, do you get concerned about credit risk with new consumers and the expansion of so many credit products?
I think that consumers understand the risks. And as well as they do here, and that is not very well. I mean, I don't think that the Latin American consumer is any less sophisticated in this regard than the American consumer, and they all make mistakes. They all, at some point, over-leverage. And if you look at probably the most developed consumer market consumer credit market in Latin America is Chile, which is a market I know extremely well. And you see, that the behavior is not very different at the end of the day. I don't think the Latin American consumer is unable to defend itself. On the contrary, it has been moving, has been becoming more and more activist, and has managed to get consumer credit to evolve or start evolving in the same way that evolved by regulation in the U.S. I mean, taking out the clauses that are more abusive, and so forth. I think that it's a matter of once you make it available, people react and go through the experience of credit, and the problems will arise. And both the regulation and the consumer movements, the consumer organizations will demand that you adjust. And that's what you have seen in Chile very clearly.
Nnamdi, what about the internet sites? Is there a PayPal model in Latin America, and how are people buying them?
There are internet payment providers. PayPal is actually in Brazil today. They're one of several providers that do payment processing. I think there's been a couple of things that we've seen that actually are good examples of probably unique innovation that we've seen with regard to kind of credit checking online. When we first looked at e-commerce in Brazil, one of our concerns was this installment process, because if you have a fast-growing internet company, they are buying the products and they're selling them, but the cash isn't coming in for several months, or couldn't be, in some cases it's not coming in for a period of a year. So you have a real challenge to grow, especially if you're growing very quickly. So we saw a couple of things that the companies were doing that were kind of innovative. If I were to use Kaboom as an example, they've actually been providing discounts for people who buy via boletos, which is effectively, instead of buying installments, you basically buy online, you go to the bank, you pay via cash transfer, and you pay all up front, and they give them a discount to do that. So that's one way they've dealt with the issue. We've seen a couple of companies develop software to do credit checking online. I think in Brazil, there's no real kind of credit registry that's very effective, and a lot of people never have had a credit check historically. So, we've seen some companies that have developed software to basically address that issue, to take into account a set of, inputs and try to calculate somebody's creditworthiness, which, helps to reduce fraud, and it helps to reduce kind of people who aren't able to pay. So there are certain ways that I think companies are innovating around that, and that's kind of a challenge that is unique to a country. And I think, to build a model that works there is a little bit challenging, but I think as a result, you've seen some good innovations.
Great. Okay. Yeah, it's true. We've seen it. Go ahead.
I just have a question on the mortgage. What are typical terms of a mortgage in Latin America?
Mortgage.
Yeah.
Well, it varies dramatically between countries. Some places you simply don't have them.
Yeah.
In the case of Chile, which is the one I know best, and they're typically 15 or 20 years. They're indexed to inflation. They're in a unit that is adjusted by inflation, and there is an interest on top of that. So your amortization is calculated on the basis of that unit. Interest rates, I don't know. Some people here may correct me, but I've seen them in the range of 3% or so. And other than that, they're very similar to the mortgages in the U.S. They trade between financial institutions and so forth, and there is a very large stock of them. That's how they work.
Because what surprised me on the consumer credit piece, a lot of retailers will actually, you're a retailer, but you also are a credit provider, and the credit is often at rates of 25 or 30%, which is shocking. If you're a consumer and you're not paying that off immediately, that thing will just compound aggressively, and there's no way you can dig yourself out of a hole. And I think, we've seen some incidents in Latin America where this has become an issue, but I see other companies where they're executing on the same strategy.
Well,
So,
I could say something about that. I think that takes us to another sector, which is an investment opportunity in the region, which is the financial sector. The reason why that happens in Latin America is because too many consumers do not have banking. They do not have access to formal banking. That's because banks tend to be very restrictive in terms of how far they go down into the lower middle class. While here in the U.S. everybody can get a checking account, in Latin America a lot of banks will not even allow a person to have a checking account because they don't like their credit. And you find that the level of penetration of the banking service is very low. So what's happened is that retailers have taken the place of banks in providing credit, and in some cases they've opened their own banks, taking the banking services to that level of the consumer. I think there's a big failure in that regard from the financial services.
Is that becoming more competitive today? Because I'm thinking, for example, I remember in Mexico, Banco Azteca and others have aggressively targeted that lower income segment and with very high interest rates. But it's been my impression that in recent years, I'd be curious in Brazil as well, if competition among credit providers is bringing consumer interest rates down.
The financial system in Brazil is much more developed than the rest of the region. So the reality is a bit different. Bank penetration is higher. So, for instance, all this credit financing we're talking about here, it's done in partnership with a bank. There's an auction among the banks to find someone who's going to provide the lowest rate. So still interest rates are still high. Most of the customers, especially the low-income customer, they don't care about the interest rates. They care about the installment. So, okay, I'm buying this fridge. If it's 100 reais per month, if it's 48 months, they don't care. They care, okay, I'm paying 100 per month. So, of course, there's a risk in doing that, but they still look a lot the installment, right? So they do that when they buy a refrigerator, when they buy a car. And the banks are totally involved in this process. We don't see, in some, like white goods, some of them, they want to profit doing that because the interest rates are ridiculously high. So sometimes they make much more money on the financing of the refrigerator than selling the refrigerator, right? And,
would you happen to know what percentage, maybe somebody knows, what percentage of the Brazilian population is banked, are participating in the formal banking sector?
I would say, I would guess 120 million people, maybe.
Out of 200, okay.
Yeah, and, but a credit as a percentage of GDP is like 50 to 60%. It's still not very high.
Okay, great. Well, I have at least one more topic that I want to throw out, but maybe it's a good opportunity to just open it up and see if there are any questions from the floor. I don't know if we need a microphone. It's a small enough room, but if anybody has a question, this would be a good time to raise your hand. I see one here.
Yeah. I wish I had a question for each of you, but I commend you for your knowledge. One of the things I see in my travels throughout the Caribbean and Latin America is one, remittances, which you haven't touched on. Yeah, the wire transfers, remittances, and so on. And the other is what in Latin America, at least in the Dominican Republic, prestamistas, the loan sharks, which is that underground market that keeps those who don't qualify for banking, as Enrique mentioned, And that is just crazy, and it's out there, and it's a lot of money being spent, particularly that lower middle income and low income. They have no other choice but that. How do you see that in your travel or your participation in your markets? Is it growing? Is it fading away? Is it still there?
I'll take a crack at that. I mean, I think that, well, first of all, the remittances phenomenon is more a northern Latin America phenomenon. It's Mexico, Central America, Caribbean, maybe Colombia. Not so much in volume from Brazil or South America, relative to the size of those economies. It's an important business for a number of countries. But the issue of informal credit, I think it's in general in the countries I do business in, we see it going down. I mean, because despite I think that banks have not penetrated enough, they are increasing penetration, and they're going down. They're seeing the opportunity to move further down the ladder, to provide banking services to the lower middle class and below. But as long as you don't have that deep penetration, you're going to see that phenomenon, and it's very unfortunate. You're seeing what you're seeing in some countries is that strong development and more institutionalization of microfinance such as in Peru, where you see very strong microfinance companies that some of the mainstream banks have entered into that segment, which is a very profitable segment, but provides credit to small, very, very small businesses, which had been the domain of the loan sharks before.
Maybe just on the remittance question, we had a company in our portfolio called Banco Dolex, which was the purpose of the company was facilitate the transfer of money from Mexicans working in the U.S. to their families based in Mexico. It was a very, very good deal in our portfolio.
You have a question here?
Yes, it's a question for you. It's basically, have you been, during the development of the financial markets, looking at those markets for raising assets? Have you been doing something?
For raising capital?
Yes.
Absolutely. We raise capital everywhere in the world. They are, I'd say the institutions in the emerging markets are accessing alternatives for the first time. They're becoming more diversified in their portfolios. So whether it's in Latin America or Asia, I think there's a lot of interest in global private equity from institutions in those regions.
I think the last 24 months, at least 8-9 funds in Brazil have been raised with more than $1 billion to invest. So raising capital is not a problem.
Yeah, both global international capital and local capital, particularly in Peru, Colombia, and Chile, where the pension funds are actively investing. Any question there?
Looking at the financial sector, that market in particular, if you look at the mortgages, you were asking about mortgage growth rates, and I grant you that Brazil is probably more developed, though Chile by far has got the greatest penetration of mortgage coverage, followed by probably Mexico. If you compare mortgage penetration in Latin America, it's at about 4 or 5% of GDP versus developed markets that are 80, 90%. So clearly there's a huge growth in that segment. And if you look at the housing deficit in some of these countries, again, it's millions and millions of houses that are in need. The banks don't seem to be able to either, Enrique, because they don't want to or they can't keep up. But the truth of the matter is there isn't enough of it for the amount of folks that need it. And so when you look at the mortgage in particular, and again, it's a more complex product than credit cards, clearly, but there seems to be indeed a real gap there in the provision of mortgages in these countries. I've been told that part of it is that they can't have enough of the stuff in their portfolio, and there isn't a secondary market, so they don't have where to sell it. And therefore, part of the reason for the lack of growth is that the secondary capital markets haven't developed in these markets well enough yet to allow for banks or just standalone mortgage originators like exist in the U.S. to exist in these countries yet, because there is anyone that would actually buy the mortgages. Would you agree that that is part of the reason why that sector hasn't developed as well yet, or do you think there is something else going on?
Well, in order to have mortgages, you have someone to hold it for, so you need to have long-term funding. In order to have long-term funding, you need to have institutional investors that have long-term horizons, or who are willing to take losses with the interest rate fluctuations, which is less likely. So what is developing the mortgage markets in Latin America is the fact that you have in the countries where you've had the pension fund reforms, like in Chile, Peru, Colombia, Mexico, what is happening that those pension funds are very, very long-term holders of securities, of debt securities, and a mortgage is an ideal investment for them to be able to pay pensions. And also they are, because of that associated to that, there's been a tremendous development for life insurance companies which provide the survivors and the disability pensions. You see that the life insurance companies are also holders of very, very long-term assets, and that is developing the mortgage markets. That's what it takes. Once you have that, and they start trading or buying and selling mortgages, you will have a more liquid market for mortgages. I think the case of Chile, that's why it has a mortgage market that is so effective, is because it did those reforms and it instituted the pension funds and so forth 10 years ahead of the rest of the countries.
Right there.
Hi, thank you. Can you talk a little bit about the entry and the exits? Are you concerned if there are any concerns, for example, in Mexico with the regulation of pension funds, that there's maybe too much money chasing ideas and you're fighting against each other to get them? And also in the exit, is there any concern about the exit into the IPO markets that are not as developed as in the developed
You
economies?
stole my last question. That's what happens for letting me. So what will the exit strategy be? But please.
I can talk about it a little. I think we're not so concerned with exits. I think they'll come over time. I think what we're seeing with our portfolio, there are multinational companies that are starting to be more active in the M&A sector. I would use the example of Folomatic, a company we invested in, which is really like an Intuit. It was kind of the Intuit of Brazil. Accounting and tax software for small businesses and accounting firms. A company called Sage, which is a large European software company, came in and acquired it this year. They thought the Brazilian market was very attractive. They paid a good price for it. I think we'll see more of that in the sectors that we look at, e-commerce. I know companies like Amazon are looking into the market more actively now. So I think that will evolve. As far as the public markets are concerned, I've actually been a little bit surprised there hasn't been more development in terms of kind of IT companies or internet companies going public on exchanges like the Bovespa. I think if I look at that exchange, there's really one software company, Totus, which is really kind of, as far as software, by and large, the biggest company, and there haven't been many. I'm hoping that will change because I think funds like ours and others will be looking to an IPO market, and I much prefer taking a company public on the Bovespa versus the NASDAQ, given kind of local knowledge and local investors. So we're hoping that will be something that will develop over the next 5-10 years.
Well, if I could add, I think I'm more pessimist about the stock market for one reason. I think in emerging markets, you don't IPO your company when you want. You IPO your company when you can. So you need to, it's a lot of volatility. You rely a lot of inflows from foreign investors. And I'm talking about a large stock market, which is the Bovespa. It's a very large. So unfortunately, so that's why you don't
Yeah.
see IT companies,
Sure.
because it's very, very, very
tough.
difficult. If you want to play retail, consumer retail, don't buy Bovespa. Bovespa, if you want to play, buy private equity. But in the Brazilian stock market is still very focused on commodities and telecom. So that's a challenge we have. And so when we invest, even though the IPO is plan A, in our strategy, we try to buy mature market leaders company, because those companies, regardless of going public or not, there's always someone that wants to buy the number one or number two. Maybe not the number 6, but number 1 and number 2. So they have a strategic value, they have market share, they have a brand. So that's somehow to mitigate the fact that the IPO market is unstable. Sometimes we have a great company, we have a great story, but the market is not there. In our case, there are companies that we were ready to go public and we have to come back. And this week, we saw a specific opportunity for another portfolio company, and we sold a very big position. So as I mentioned, is when you can, not when you want. So that's the...
I just mentioned we've been hearing this from a lot of fund managers in Brazil and across the region this year. A lot of portfolio companies that they were planning to IPO, and I'm not going to name names, but those companies have been held, not because of anything that's going on specifically in Latin America, but just because of the volatility of global markets and the big movement of international investors. Now, on the other hand, Fernando, you guys acquired Qualicorp and turned around and IPO'd it, like that.
Yeah, having said
really
that.
successfully.
Qualicorp was probably not the last one, but almost the last one that took the window in 2011. After that, we didn't see
First
any
half,
other.
that was like the July or so, because there were quite a few private equity-backed IPOs in the first half of 2011, and then it's been really almost dead since then.
And we paid the price for that. It was a very tough, it's a fantastic company, but it was a very tough IPO. We accept a price much below the range that the banks initially offered, and because we didn't know where there would be another window. And then the company performed, the share price increased substantially, and this week, ended up being a very good deal, fantastic deal for us, but was not easy. But I see this as an opportunity, because there are few assets in consumer retail in the stock market, so there's a scarcity value. You see the multiples of the few companies that are there. They're trading at a very, very high multiple. So if you have good stores, companies with good fundamentals, the stock market is there. And I also the rest of Latin America, with the merger of the Peruvian, Colombian, and the Chilean stock market, you will see this happen as well. People want to buy retail. They want to buy growth stores, and so you just need to find a window.
But I guess what I'd add is it's nice today, though, because there's multiple paths to exit. So Qualicorp was a secondary acquisition, and the secondary private equity market is evolving in Latin America. There's also strategics who are in developed market economies that are flat or declining, and they need to buy growth. So if you Diageo, for example, a British spirits distiller, distributor, part of their strategic focus over the next 2 or 3 years is to go out and buy the market leaders in the emerging markets. They've done that in Brazil, they've done it in Turkey, they've done it in India, they've done a joint venture with the leading brewer in Vietnam, and this is that's Diageo, but there's a number of other developed market kind of leaders with big balance sheets that are looking to buy growth in markets like Latin America.
Enrique, what's your exit strategy?
As Scott was saying, there are multiple paths to exit, and in many cases we have a dual path going at the same time. We're looking at IPO, we're looking at strategics, and we try to exhaust the strategic option, which is always a one shot, you're out, before we go to the IPO. And particularly, where we're talking about IPOs in the Andean market, you have, yes, the potential of a bigger market someday, but today you have to deal with three, and I want to include Mexico in that, four small stock markets, because Brazil is the only large stock market in Latin America. You have four small stock markets that talk a lot about becoming an integrated market, but they're not. And when it was interesting that a couple of days ago I had a presentation from an investment bank on doing an IPO of a company in a certain Andean country, where their recommendation, if you wanted to sell to the Chilean pension funds, was to list it in New York. Not to go list it in, say, Lima or Bogota and go and sell it in Santiago, because the pension funds in Chile are not, the pocket they look into when they invest in that company is the foreign investments. These are non-Chilean investments, and it's the same thing if it's listed in New York or elsewhere, but really New York is a more liquid market and they look better at that and so forth. So go list it in New York. It doesn't help to go and offer that. We've done offerings that have quote unquote covered the three markets, but really you're covering the market where you're listed. Your listing in one country doesn't really make it a public a security that you can offer publicly in the other countries. So maybe the stock exchanges have an agreement, a corresponding agreement for the brokers to be able to buy stock in the other country, but you cannot offer them publicly. You have to do a private offering in the other two. And it doesn't qualify for the portfolios, for the larger chunks in the portfolios of the pension funds. So there is really no market. And then to add to that the pension funds dominate these markets. They're few. They're few in each country. They dominate those markets, and they don't have a lot of alternative investors, other investors. Maybe Chile has a few more now, but what you end up doing is negotiating your price with 2 or 3 big institutions that tell you what the price is, unless you've again listed it in New York or done a 144A in order to get a broad spectrum of investors. Recent recommendation in Mexico to do an offering is don't even think about doing it without a 144A, because otherwise you're going to have to be dealing with 2 or 3 of the larger institutions here who are going to tell you what the price is. So I think there's a lot to be done in terms of really creating integrated markets, and today they're not there.
Okay, maybe we have time for 1 or 2 more questions. I see a hand there.
Hi, I wanted to know more about how are you managing the problems about competing with other private equity companies, locals, but also with strategic companies that might be also wanting to invest in companies. For example, in the case of Peru, you have that insurance companies are bidding really high prices for different laboratories or hospitals.
So the competitive environment, this is kind of maybe, if we're coming up against time, a nice note to close on, the competitive environment for deals in Latin America.
Well, I mean, for many years in Latin America, we complained that nobody wants to invest there, right? Nobody wants to put money.
It's not the case anymore.
So there's not enough funds, not enough. And I mean, I think we need to live with competition. I mean, if the market is not good enough for the GP competing, it's not going to be enough for the LPs, right?
Yeah.
So, I mean, it has become more competitive. So there are much more money to be deployed there. On the other hand, it has become a much better place to invest. The risk of investing in Latin America today, in my view, is much lower than it was 10 years ago. In some places, and I talk more about Brazil, but I mean, I'm much more optimistic about the next 10 years than the last 10 years in private equity. I mean, you pay more, but you buy better assets. You buy cleaner companies. It's much easier to digest the companies that you buy. If I look 10 years ago, I mean, many companies you could not even visit the company with taking the risk of getting some liability just for meeting the company. So, I mean, that changed a lot in Brazil. And so today you pay more, but you buy more assets. You pay more in Brazil is not because there's more competition. It's because Brazil is more expensive. I mean, you go to a restaurant in Brazil, you take a cab in Brazil, it's more expensive. It's not only because there are 20 funds chasing a deal. That's not the reality we see today. There's much more funds, but not everybody's looking the same kind of deals. You have a lot of niche funds. Some funds only do controls, other funds only do minorities, others do venture capital, to private equity. Some like to buy 100%, or they want to have a very minority. So, I mean, there are different strategies, and also the number of deals have increased, right? So, especially with the stock market the way it is, there's a lot of companies that want to talk to you. And I was mentioning to you earlier today, like, especially in Brazil, they are very, private equity still has a good reputation there. And the entrepreneurs are very open-minded to talk to private equity, which is not the same reality in other places. So we see what we see is a market that is developing, become more mature, but it's not like it's still very far from the kind of competition we have in China, India, or developing markets. So it's
You set it up for Scott to talk about how Latin America compares to other parts of the world.
Well, let me. I just want to add on to, as an investor in funds like Fernando's and Enrique's. I think the important thing is that you invest with somebody who's local, who has local network, local knowledge. They understand the local business practices. That way they do truly have proprietary deal flow, even if that proprietary deal flow is just through a relationship. And I think that's so important in Latin America. The other thing that these guys have is that they are long-term capital that's dedicated to the region and will not exit the region when things turn bad. And trust me, things will go bad again, and the strategics will exit, the globals will kind of retrench, but the local private equity investors will take advantage of that opportunity, and we've seen them do it as recent as 2008, where some of the best deals were done during that period of time when basically capital dried up. So I think the way to compete in a local or in a competitive market environment is to invest with guys that are very much local in those markets. And then the other question.
Supposedly Latin America, much lower penetration of private equity investment to GDP than places like India and China.
Yeah,
and kind of a gold rush into those
You're
markets.
You're going to get me into trouble here. I've been in Asia now for 2 years, and India and China have taken increasing share of the market from an LP standpoint. Very different markets than we find in Latin America. There, many of the managers are actually doing minority investments. They're many times passive investors. Transparency is not something that is prevalent across those markets. So, I'll be honest, as a guy that just spent 2 years over there, very hard to figure out. You got to probably spend a decade. What's nice about Latin America is it is generally a control-oriented investment environment where the private equity manager has the ability to influence changes in management, influence an exit, influence the company. It is a mature private equity market. Many of the most successful private equity firms today have been doing it for over a decade, and they've lived through both good times and bad times. And it's just a market that's more, from my point of view, easier to understand, more similar to what we see in the buyout and private equity markets in the U.S. and Europe, but somewhat simpler. I mean, it's about growth, it's about execution, it's about value add, in helping companies professionalize themselves with just basic kind of blocking and tackling, and there's a lot of value that can be created as a result of that.
Great. Enrique, competitive environment for you. You're not technically local because you don't have really an office that you're generating deal flow out of in the region, and yet you've been very successful in doing deals. A lot of new firms coming in. Is it more difficult for you today? Are you optimistic about the opportunities down the road?
We do have an office in the region.
Well,
we have an
I'm
office
sorry.
in Santiago.
Yeah, that's
and
true.
it generates quite a bit of deal flow. Yes, I think that today we're seeing it more competitive, but the competition we see is not necessarily coming from private equity. We think that the strategics and other local investors are the biggest competitors that we face. We see companies bid up by local groups, local family offices, or that type of investor, making it more pricey at the end of the day.
Okay. Nnamdi?
Yeah, I think I would agree with you guys in the sense of we have seen more competition in our kind of target regions in LatAm. I would say it's more today non-Brazilian funds. It's more U.S. funds like Excel or Sequoia or General Atlantic. I think I'd like to see more kind of domestic venture capital firms focusing on kind of the early and growth stage investing. That hasn't been the case, but I think it's increasingly the case. I think we've partnered with firms like Monashis, which is an early stage fund. So I think it's an opportunity for fund managers or aspiring fund managers in Brazil to really to start funds, because I think the local domain expertise, local knowledge is important. I mean, we like to see that and partner with those types of funds. So I think it's an opportunity for local managers.
Right. That's been an area of huge focus for LAVCA over the last year and a half, has been the venture capital and early stage segment. We've grown our membership there. Nnamdi joined actually this year after we made a trip to Brazil with Silicon Valley Bank and a group of Silicon Valley VC firms to the region. And it's true, there are very few funds on the ground still locally. You can really almost count them on one hand, but it seems to be an area that is inevitably going to move forward. So with that, I think we'll close the panel. Thank you very much to the panelists for the time and everyone coming here. Thank you to Council of the Americas for hosting us again. It's always wonderful to be here. And thank you so much to all of you for coming in and spending this time with us. And again, just encourage you to reach out to LAVCA in any way that you want. You know where to find us.